This time is different. These are the 4 most dangerous words in investing. But let's be honest, most of us think that this time is different, when it comes to crypto at least, even if we refuse to say it out loud. But what if I told you it actually might be, and that it could be even more bullish? You see, some have noticed that the crypto market has historically followed the business cycle, which appears to be extending into 2026. This suggests that the crypto bull market could also extend into next year. That's why today we'll explore how the business cycle relates to crypto, whether this theory holds any merit, and answer the controversial question, could this time really be different? Stay tuned to find out. Before we begin, you need to know that I am not a financial advisor and nothing in this video is financial or investment advice. This video is purely educational content and is intended to inform you about the crypto market cycle. If that sounds good to you, then prove it by pounding that like button and let us know in the comments where you think that we are in the current crypto cycle. Now, let's start with some context. If you've been following Bitcoin's price action, you're probably wondering when it will reach its cycle top. For a long time, the general consensus was sometime this year, with many predicting Bitcoin could peak around late Q3. Well, we've just entered Q4 and there's no clear signs of a cycle top. So, what gives? Well, according to macro analysts like Raoul Pal, the crypto market could be in an extended cycle. This means that Bitcoin and altcoins might not hit their peaks until sometime in mid-2026. This is a bigger deal than you might think, because it would basically invalidate crypto's historical 4-year cycle, which is based on the Bitcoin halving. Naturally, Pal argues that the crypto market cycle is no longer based on the Bitcoin halving. That's because there's evidence to suggest that the crypto market follows the economic cycle and always has. This begs the question of which economic indicator we need to be looking at. The answer is the Institute for Supply Management's Manufacturing Index, or ISM for short. Put simply, the ISM gauges monthly economic activity by surveying managers across industries. When the ISM index is above 50, it signals expansion in manufacturing, meaning the economy is growing. When it falls below 50, it indicates contraction, and the economy is slowing. And since the ISM report is one of the earliest economic indicators released each month, it plays a major role in shaping investor and business confidence. Now, here's where things get interesting. If you draw the crypto market's 4-year cycle as a sine wave and then layer it over the ISM, the correlation is uncanny. Every time the ISM has peaked, this has corresponded with Bitcoin hitting its cycle top. And every time that the ISM has bottomed, Bitcoin has hit its cycle low. And wherever Bitcoin goes, crypto follows. However, this pattern has now broken. For the first time, the 4-year sine wave has reached its peak, but the ISM hasn't followed. Instead, it has stayed subdued longer than ever. Specifically, the ISM has remained below 50 for 7 months, signaling economic weakness. According to Paul, this explains why the crypto market has felt so underwhelming in recent months. So why hasn't the ISM picked up? Well, the answer lies in the debt refinancing cycle. For context, it's believed that global liquidity expands and contracts based on when debts need to be repaid. Historically, global liquidity followed a 4-year cycle just like crypto, and it just so happened to correspond to Bitcoin's halving cycle. What's fascinating is that Pal believes that the average debt maturity increased from 4 years to around 5.4 years as a result of the pandemic. This means that the debt refinancing cycle has been extended. This means that the liquidity cycle has been extended, and in turn, the crypto cycle has been extended. In this sense, the ISM is just a way of measuring liquidity. Well, the current ISM is projected to rise into late 2026. Which suggests that the crypto market could possibly continue rising until then, with some pullback along the way, of course. And if you're looking to trade these ebbs and flows, then you have to check out the Coin Bureau's deals page, because that's where you'll find exchange sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges. Just hit the link in the description or scan this QR code, which will take you straight to the deals page. There, you'll see all of our offers across a range of exchange partners. Simply click one of the Sign Up Now buttons, and that should take you right to the deal. These deals won't be around forever though, so take advantage of them while you still can using the link below in the description or by scanning the QR code on the screen. Now, let's talk about the flip side to the ISM thesis. While some macro analysts like Raoul Pal believe that the ISM is a great way to get a sense of liquidity trends and where the markets are heading, well, other macro analysts disagree. Some have even gone as far as to argue that the economic indicators like the ISM have nothing to do with global liquidity whatsoever. One of these macro analysts is Michael Howell, the CEO of Cross-Border Capital and an expert in global liquidity cycle. In a recent interview with Julia LaRoche, Michael said point blank that those relying on economic indicators are likely to be misled, as the correlation between these indicators and global liquidity are not very clear-cut, according to his research. Michael also pointed out the obvious, which is that many economies have flatlined since the pandemic, but this hasn't significantly affected asset prices. According to him, quote,
"We've faced an absolutely plain vanilla investment cycle. Everything has gone pretty much according to normal script."
The catch is that this script hasn't worked well for crypto. If you're terminally online, chances are that you've seen charts comparing global M2 to Bitcoin's price. Funny enough, one of the most popular charts came from none other than Pal and his research team, who had been warning for some time that there could be a breakdown in the correlation between these two metrics. Well, that's exactly what happened. As you can see, global liquidity has continued rising since the summer, but Bitcoin has essentially flatlined. This is probably why you don't see the global M2 liquidity charts as much anymore. They don't seem to be accurately reflecting what's going on in crypto. Obviously, this lends itself to alternative theories like the ones proposed by Powell. However, this doesn't change the fact that global liquidity drives the markets at the end of the day. Global liquidity was to start falling, the crypto market could start falling too, even though it has struggled to keep up with global liquidity in the recent months. Well, that's exactly what Michael is warning could happen next. It looks like global liquidity is peaking and it could start contracting. The reason? Central banks. Michael's research shows that central banks aren't being as accommodative to the credit markets as they need to be. Remember, global liquidity increases to help refinance debts. If global liquidity doesn't increase, debts can't be refinanced, and you start to see the issue. Lo and behold, we've recently started seeing issues in private credit. Even though the Fed recently cut rates and announced that it would be ending QT, this might not be enough to create the necessary liquidity to refinance debts. In the Fed's defense, many of the debts in places like private credit are opaque and complex, which makes it hard to get a sense of exactly how much liquidity is needed to address the stresses in those markets. And by the way, you can learn more about private credit using the link in the top right. So, is the economy sliding into a recession? Well, now by this point, you may have noticed that there are two worrying factors here. The first is that the ISM is lagging. According to Raoul Pal and other like-minded macro analysts, we should have seen the economy pick up in the summer, but, well, it didn't. Meanwhile, Michael Howell's global liquidity cycle suggests that liquidity is close to peaking and that a contraction is coming. This begs two questions. And the first one being where we actually are in the economic cycle and whether the economy is actually sliding into a recession rather than preparing for a reacceleration. The answer is a mixed bag that doesn't look very good. That's because even with the US economy showing signs of slowing down, it's still technically chugging along. This is because of a few factors, the one of which is inflation. As a not so fun fact, inflation is factored into data like nominal GDP, and can make the economy seem much stronger than it is as a result. To use a simple example, we'll just talk about consumer spending. Consumer spending can continue going up, not because people are actually buying more, but because prices are going up. Another economic factor that's similarly deceptive is unemployment. On the one hand, unemployment is rising because there's less hiring. On the other hand, though, unemployment is falling because there isn't as many people. The result is a benign unemployment print that makes it look like the economy is doing fine when it's really not under the hood. In fact, many US states are already showing signs of significant weakness. According to recent reports, 22 states in the US are technically in a recession, with another 13 reportedly hanging in the balance. This suggests that more states could soon face economic turmoil, and this could in turn tip the US into a recession at the federal level. This begs the second question, and that's what's really going on with global liquidity. The answer is again a mixed bag. but for different reasons. Whereas economic data is suboptimal because many of its data points deal with stuff that happened in the past, liquidity data is suboptimal because many of its data points deal with stuff that could happen in the future. Put differently, liquidity forecasts make a series of assumptions about central bank, commercial bank, and government actions that may not actually materialize. Notably, this is true regardless of whether we're looking at a liquidity analysis from Raoul Pal or Michael Howell. Both of these liquidity projections can change significantly if there's a change in action from key players. There's also the implicit assumption that assets lag new liquidity injections, which might not be true. Take the Fed's forward guidance, for instance. When the Fed says that it's going to cut rates or do QE, the market will immediately rally in response to the future increase in liquidity, even though it hasn't happened yet. When it actually does happen, sometimes there's a sell-off. This is extremely important to keep in mind because it means that the global liquidity picture could change on a dime. If central banks suddenly start cutting rates, or if commercial banks suddenly started lending more, or if governments suddenly started spending more, there would be a surge in liquidity that would be immediately priced into the markets, especially crypto. So, what's driving economic growth right now? In case that didn't make it clear enough, this means that the truth lies somewhere in the middle. Yes, the economy is weak, but it's not recessionary, and it could still expand. And yes, global liquidity is probably peaking, but it's not contracting yet, and it could likewise still expand also. Case in point, the probability that the US falls into a recession actually fell after the Federal Reserve started cutting interest rates again in September this year. Logically, forecasts for global liquidity have also improved as a result of the Fed announcing that it would stop doing QT on December 1st, potentially foreshadowing QE to follow. When it comes to the private sector, many companies have continued making solid revenue despite the apparent economic weakness. At the same time, many companies have managed to cut costs using AI, increasing their overall profitability. The caveat is that most of the economic growth coming from the private sector has come from AI-related ventures. This is, of course, especially true in the US, where investments in chip manufacturing, data centers, and infrastructure has accounted for a jaw-dropping 92% of GDP growth in the first half of 2025 alone. In fact, the surge in AI investment has been cited as a key reason the US economy has weathered President Trump's trade war. Thankfully, the AI bubble has also had positive secondary effects on other sectors of the economy, like commercial real estate and energy infrastructure. When it comes to the public sector, fiscal spending, aka government spending, has been a major contributor to growth, especially in economies where the private sector has been struggling. Most of this government spending has gone into sectors deemed to be important to national security, such as infrastructure, defense, and technology. This investment boosts demand in the short term and raises supply potential in the long term, which is exactly what you want for long-term growth. The catch, though, is that how much a government can borrow depends on how many buyers there are for their bonds. Excessive bond issuance can ultimately undermine growth rather than support it, as buyers of these bonds may be less keen to buy them as their supply increases. It's really just basic economics. So, what does this mean for crypto? Well, it means that crypto is probably going to continue chopping and grinding up and to the right over time, just like the economy. It's easy to forget that Bitcoin and large altcoins are almost exactly where you'd expect them to be at this stage of the cycle, close to all-time highs and looking like they could get that final parabolic breakout. And of course, the reason why this is easy to forget is because many existing crypto investors have been holding primarily altcoins, which have been grinding down and to the right for years. In theory, this means that this time is different. In practice, everyone forgets that altcoins rally the most at the final phase of the cycle, which should still be ahead of us if this time is the same. And this brings me to the big question. Is this time really different? Or is this just one big elaborate way of trying to justify the underwhelming price action of our portfolios? Well, the short answer is that it's simply too soon to say for sure. While the ISM theory suggests that the crypto market cycle could be extended, the reality is that Q4 has only just begun. There's still plenty of time for crypto prices to explode and reach their all-time highs before drifting down into bear market territory. Although the global liquidity cycle is likely peaking, crypto tends to decouple from global liquidity at its own cycle peak. That said, though, there are a few factors that make the current crypto market cycle significantly different to the previous cycle, particularly from a macro perspective. For example, previous cycle featured ultra-loose monetary policy, with central banks like the Federal Reserve cutting rates near zero and launching large-scale quantitative easing in response to the pandemic. Risk appetite was high, retail participation surged, speculation dominated areas like meme coins, NFTs, and DeFi. And of course, regulatory frameworks and institutional crypto infrastructure were also less mature. It's worth noting, though, that there are many metrics which suggest that retail participation is bigger than ever. The kids are just playing in a different pool. As some of you will know, most of the rally in the stock market has been driven by retail since the spring. Not only that, but we've seen trading volumes on speculative assets like penny stocks far surpass their 2021 highs. What this means is that it might not have anything to do with the economy or with liquidity. It could just boil down to attention and the fact that people had more time to pay attention to assets that were more out there, like crypto was, in the previous cycle, simply because they were locked down and pretty much had nothing better to do than learn how to use exchanges and DeFi protocols. From our perspective, assuming we avoid a recession in the near term, we expect the crypto market to play out as it usually does. Q4 of 2025 should be bullish, with at least Bitcoin hitting its cycle top. If history repeats, then Ethereum and altcoins should top out roughly 1 month after Bitcoin does, whenever that turns out to be. But what do you think? Let us know whether you think this time is different in the comments below. Okay, so if you want to see whether your altcoins could recover, then check out that video right over here. And if you want to see how the bearish sentiment could actually be bullish, then, well, you should check out that video right over here. Thank you all so much for watching. This is Lewis, and I'll see you in the next one.